Thank you very much, Evelina. And first of all, before we get started, I'm pretty excited for our first AI in Finance conference. Even if I might have come up with the idea in the first place, without Evelina, it wouldn't have been possible to get this all off the ground. So therefore, thank you very much, Evelina, for organizing it. And of course, also a big thank you to everybody who is helping out in different capacities here. Really, really grateful for that. Yeah, AI in Finance, overhyped or underappreciated. We have seen already a couple of applications, and I want to go through a number of thoughts and aspects in this regard in my high-level talk. So no code, that's pretty, I would say, exceptional for me, but that's the way it is. And let me dive into my slide deck. Now let me try, yeah. Here we go. Here you see the books, the 6 of them that have been published on the topic. I've also published, I don't know, beyond my PhD thesis, 2 books in German. They haven't been bestsellers, to be honest. But they sell somehow here, in particular the O'Reilly books. And yeah, as you can see, even the quote-unquote oldest one here, the Python for Finance, my biggest one, has already machine learning for finance in it. The second edition came out in 2018. The first edition has 10-year anniversary this year, so 2014. And all the others, as you can imagine, like Python for algo trading has machine learning in it, artificial intelligence, the title says. It all in finance has basically this topic exclusively. The older ones, that's my background, quantitative finance, they don't have machine learning yet, right? So in the Wiley books, you won't find that, nor will you find it in the introductory book. But my next one coming out soon, this year, Reinforcement Learning for Finance, again, focuses now on this particular method. And I think what the subtitle says here, promising yet underutilized method in finance. So far, many applications that you can see, that you can read online, papers, etc., are based primarily on supervised learning. We've seen a couple of elements in this regard, but I think reinforcement learning is indeed promising as an alternative in many different circumstances, right? And tomorrow, the workshop, if you're interested in, we will have some 3 hours, 2 times 1.5 hours. We will focus on certain elements out of the book here. Right. So this is what we do for a living. It's our program, the CPF program, which has grown over the years tremendously. Yeah, here you see a couple of numbers. Not all of them. I don't know why it doesn't show it really here. But this is really comprehensive and has well more even than what is already in the books. That's just for reference. I think this was the text where he was reading from, right? So traditional finance, let me get started with, from my point of view, setting the stage and how I see it. So just to remark up front, even though I'm going to criticize several of the traditional models and approaches, I'm a big fan of finance still today. So when I first read, I don't know, Corporate Investment or whatever paper, whatever book back in the days, it was so excited. You learn before that I have my degree, my diploma in business administration, but I focused really once I discovered finance on the, yeah, in that sense, traditional finance side, because I was excited and amazed by it from the very beginning. So the criticism is from a point of view where I was a lover and I'm still a lover. Right? So cornerstones of finance, and here I think it's still one of the standard textbooks these days to get a start into finance. And here it's I would say a personally biased selection of cornerstones of finance, like expected utility. And I must say I did a lot indeed of microeconomics when I was studying. So the foundation, I would say, a little bit below, quote unquote, of the traditional finance part. Also equilibrium theory, where you see the X here. I think that these methods that you see here and these assumptions, like normal distributions and linear relationships, and I'm not telling you something new here, are models, assumptions that are either not good in practice or are not found in practice, right? While physicians can deal with, or physicists, sorry, not physicians, physicists can deal with normal distributions quite often. For us in finance, they are an approximation, but most often they are not a good one. Also linear relationships, that are nice, that are easy to handle, they aren't in general a good approximation of what is going on. On the other hand, we have, of course, success methods like the efficient market hypothesis. I will come to that later on in arbitrage pricing. I told you that my background is in quant finance, option hedging, etc. I think these are real success stories in this area. So just a few pictures here: theory, normal distributions, reality. We have fat tails, high peaks, and everything else that we know about real financial particular returns distributions, right? It simply doesn't reflect reality. We've heard about regimes and that there are market crashes that are outliers from a certain point of view, etc. So this is stuff that you need to deal with in practice, and that traditional models that rely on these simplified assumptions typically cannot handle properly, right? And physics might be good in many different circumstances in finance. It might not be the best thing to use, right? So then we have the linear relationships. Here, the capital asset pricing model dating back to the 60s, right? It's nice, it's easy, it's intuitively appealing. Yeah, but it's for sure not today one of the better performing models or good approximations of what is going on in reality, right? Still, people talk about beta, use this in certain contexts, right? I will come to one example, which is even codified law in German, which relates to this model and the way the cost of capital is to be estimated. But as you might be aware, there are certain issues that we need to take into account here, right? So that's already the case that I was referring to. So here I have a screenshot from a website. I think there's a link behind that screenshot. It's from a German accounting firm, and they explain here in detail on the webpage how it is according to the German, and it's called AIIFC standard. Right? This is kind of law, for example, when you sell a company or when you have an inheritance situation, whatever, and the company value needs to be calculated, then there is an exact procedure described here, according to which you need to estimate the cost of capital, and this relates then to the capital asset pricing model, etc. pp. So it's really codified law. But on the other hand, if you have a look at the empirical side of things, right, here from this famous 2004 paper by Farmer and French, capital asset pricing model theory and evidence. The attraction of the CAPM is that it offers powerful and intuitively pleasing predictions about how to measure risk and the relation between expected return and risk. But now they come to their conclusion. The version of the CAPM developed by Sharp and Lindner has never been an empirical success. The problems are serious enough to invalidate most applications of the CAPM. So that's not like from yesterday, it's like from 20 years ago. And still, like in Germany at least, and when you pick up any kind of discounted cash flow company valuation book, you will find more or less the exact same procedure. Not that the capital asset pricing model doesn't work well in this context, it neglects so many things like asymmetries in a corporate context, meaning that most corporate decisions have the characteristics more of an option. It's kind of a real option, which is also a topic on which I have published one of my German books, right? Real options pricing and real options theory to be used in a strategic corporate context, right? And this leads to so many issues where I say, well, this approximation might be nice and easy to implement, but basically what you're doing there is so well off, right? So engineers who are building airplanes would never get any airplane off the ground when they would use some rough methods comparable to what we use here in finance. Still, again, I'm loving all these theories. Every once in a while, I read even the original papers once again. Okay. So, what are prices? Here I have a screenshot because I didn't want to write it down from a paper, and the authors have been referenced before. I think by Hein Ming in the other one of the first talks that we had, but this is a rather recent paper. And when you get access to my slide deck, there are usually behind every source or a screenshot or whatever, there's a link where you can then visit the site where I got all of this from, or the paper that you can then download. And this paper here, the 2023 paper, is called Financial Machine Learning. And it's pretty interesting, I would say. It's a summary more or less of, I would say, what machine learning has done, can do in the context of financial research. Now, that in an applied perspective, I have another paper that I reference later here, which is more applied in terms of asset pricing, right? So prices are predictions. We all know this, right? Depending on the information set that an individual has available, maybe some marginal rates of substitution in the future, meaning in general discount rates, right? You come up with some discounted cash flow, let's say. This would be one way of interpreting the equation 1 that is here, right? I've done this in my life as a management consultant that often in that context, right? For a project, for a company, for whatever, you calculate the free cash flows and then you have a discount rate again in the context of the IDWS1 standard in Germany. You would then go ahead and estimate the cost of equity, the weighted average cost of capital, use this for discounting, given the capital structure of the company, etc. But this all is, of course, based on some information set that is available at a certain point in time. Right? So prices are predictions. And when we think in this term, I would say prices are kind of central to finance, and therefore finance is somehow a discipline which is concerned with predictions. Right? That we need to come up with a company valuation, that we need to come up with a fair share price, with whatever, a fair price for a bond or a fair rate, or an equilibrium rate, or fair market value, or whatever this might be. But how good are finance people and economists and practitioners in terms of predicting prices, right? But here we need to distinguish, right? This is kind of the view that you say, I want to have a point estimate today, given something that is happening in the future. But the other way, and this is what we have seen mostly these days, where people try to predict such a price in the future, right? And so they're a bit different here. So prediction of prices and prices are predictions. So we need to here have basically two hats on. And therefore, how good are financial people, let's put it that generally, are in terms of predicting prices? And does it work? And here I like these two charts. They are from the Wall Street Journal, from the article. The context, I would say, doesn't matter that much. I hope you can see this. Please, do you all see kind of like these light blue lines here? It's difficult to see, right? It's one of the key charts here. But somehow you should see it, and you should have an idea, right? Here on that screen, it's much better than when it's projected. So this compares how, in the first case, on the left-hand side, the 10-year Treasury yield has developed in reality, right, over these, a bit more than 20 years. On the right-hand side is the federal funds rate and its market expectations versus realized. And you will see that at any point in time where they have collected the predictions of market participants, all the professionals that earn like hundreds of thousands, sometimes millions, right? Teams of people in investment banks, in hedge funds, in whatever, when they form their expectations, they never get it right. Actually, never, right? This is, you see it here. So over this long stretch that we all know, this low yield, low rate environment, where it was completely flat, every time it says they will go up, they will go up, they will go up. There is not a single situation, right, where you would say, well, they have been somehow out here, where it chops down again at the prices, or it's the prices, or we've seen it. Here they were saying, well, it's going like this. And then on the other hand, the predictions have been much too low compared to what the Fed has been doing. The same holds true here for the 10-year Treasury. Right? It always says basically it goes up, but it always takes here much, much longer until it gets to some level that was expected the time before. So economists, practitioners, I don't know, whoever this is that they are polling here, they don't get predictions right. So it seems to be a pretty difficult task here, right? I would agree that it's of course difficult when you say there is kind of the recession, or there's kind of this crisis, or there's this market crash. these are the rare events, the outliers that are difficult to predict. I would agree to that, but basically here you see it doesn't work no matter what regime we are in, no matter what period of time we look at. So yeah, with all the history in terms of macroeconomics and microeconomics and finance and all the models that are available, it's a bit surprising that these fundamental quantities seem to be so difficult to predict, or in other words, right? So I was writing here, empirically, finance has a pretty bad track record in predicting prices, right? So there are obviously no models available that somehow can capture what is going on here. And there have been recently also so many articles about how bad, obviously, the models of the Fed are in terms of predicting inflation, etc., and acting accordingly. I would say one of the fundamental tasks that finance should fulfill seem to be not kind of fulfilled or given to a certain reasonable extent. They always try hard, but they're never going to fly. It's if you would have such a judgment as an employee, this would be a difficult time for you probably going forward in the future. But the whole market lives like that, obviously. Right? So therefore, it might not surprise that as one of the few theories that have been invented in the, or people have come up with in the 60s, 70s, so that have been tested thoroughly empirically, is the efficient market hypothesis, right? So markets appear at least to be efficient, meaning that prediction methods are inefficient. So here from the original text by Eugene Farmer from the 60s, mid-60s, one quote that I like to use: in the end, if prices are random walks, then the various technical or chartist procedures for predicting stock prices are completely without value. Still, people sit in front of their trading apps and try to use, I don't know, simple moving average, try to use whatever, RSI, Bollinger Bands, etc., and try to predict prices in the future. Well, so far, I would say nothing has changed that much. There might be a few exceptions, like there always is. If there are a million traders, day traders do that, there for sure are probably a few that get it somehow right, like the Warren Buffett phenomenon, I would say. As an outlier, you will find there, right? And in that sense, this is my summary, and others put it that way as well. In such a case, in a least square sense, at least, the best predictor of tomorrow's stock price is today's stock price. This is what efficient markets are about. Anything that might be relevant to the price, the current price, or the future price, is already in what you see in the markets, and there is no value in trying to predict it. We have seen it, right? Here, basically all predictions have been wrong. Basically all of them. There's not a single time, maybe one or two instances where you could argue that the predictions are somehow in line with what the market did afterwards. But if this is 2 times out of, I don't know, 50, I don't know if this is a good winning ratio here. Maybe this might be true to the fact that there is what is called physics envy. I think every economist, finance practitioner, researcher, student should read this paper. So finance might have been driven for too long by the quest for the most simple models, right? And what this basically says is that we all know that physics, and going back to our German Albert Einstein, right? Physics has a large number of equations that are so simple, like F equals m times A, or E mc squared, right? One of the most famous equations. And we have that as well. We have the capital asset pricing model, and we have a few others, right? Like these, but this might be, as we can read here, hazardous to your wealth, right? When you rely on such simplifying approaches in practice, however appealing they might be intellectually and however mathematically rigorous they might be implemented and might be proven, right? So I have a bit more as an example a few slides later in terms of a summary of this particular paper. Again, you will find here behind that screenshot, you will find the link to the paper, which you can download from SSRN. It's a little bit large of a paper, so it's probably not a read for a single hour. but it's worth reading, right? So now coming to AI. The question, is AI coming to the rescue? I've seen a couple of applications today, and I want to basically differentiate in two major different roles of AI and what it can play in terms of these roles in the financial domain. So I want to get started with AI as technology, and this is what we have seen basically this morning, right? When we talk about natural language processing, where we have some type of new method, technology that we can apply to a financial problem and try to improve upon whatever has been there before. Or in terms of regime detection, I've seen a number of methods that are applied to this problem and to answering a certain question, or maybe to improve upon, again, something that exists, or by Francisco, like in terms of trying to predict in a time series sense, time series flows data in order to improve upon any other prediction method, right? So this is what I see in terms of AI as technology, or maybe we would say, me as a car guy, it's the engine here that I mean in this context. So the scientific method, also something that I like to get started with in such a context. Scientific method involves the refutation of models that lack empirical support, and you read it here, screenshot the explanation from the dictionary, Oxford Dictionary, right? A method of procedure that's characterized natural science since the 17th century, consisting in systematic observation, measurement, experiment, and the formulation, testing, and modification of hypotheses. And why is now AI, and with AI, I mean like all the methods that might jump to mind, right? Like unsupervised learning, supervised learning, reinforcement learning, natural language processing, etc. Right? So this is for me like the one expression that subsumes all the other methods, right? And why is this so interesting? Yeah, machines effortlessly test and refute thousands of different hypotheses. So when you think really in terms of the scientific method and what machine learning can do for you, it simply scales like this whole scientific process, right? Scientific method on steroids is what Pedro Domingos writes in his book. It follows the same process of generating, testing, and discarding or refining hypotheses. But while a scientist may spend his or her whole life coming up with and testing a few hundred, I don't know, maybe a few dozen hypotheses, a machine learning system can do the same in a second, right? It automates discovery. It's no surprise that it's revolutionizing science as much as it's revolutionizing business. Think of applications, completely other domains like the deep mind, protein synthesis, application in biotech, etc. So there's so many areas of application these days where it's indeed revolutionizing science, right? In business, we have seen already a couple of applications, and I think this is where really the beauty comes in, that the machine is relentlessly testing different setups. And when you then go back, I was criticizing before the capital asset pricing. Well, I mean, back in the 60s, what did you have? Pen and paper, right? You've had maybe a few assistants that were helping with the questions that were required, but that was basically it. Not to speak of data availability, right? Really small data sets, and it was kind of like what they have been constrained for. Therefore, these simple models have not been driven back in the days, from my point of view, only by the physics envy, as it was called before, but also simply by the means that have been available, right? By what was reasonable in order to expect what you could do with your time. This is here, of course, related to time, even the lifetime of researchers, right? So, and they were really, really constrained, and it took quite a while. Then there were like punch cards, and it took a while until every researcher has had the machine, a computer, maybe a PC, or maybe some early Apple machines, right, on their desk. And up until today, where we have our really fast MacBooks or Intel gaming notebooks on our desk, and then can do thousands, millions of times more than was possible, even thinkable back in the days, right? So this is, I think, one part of the big beauty associated with machine learning, right? And in that sense, the efficient market idea from the 60s, or here the quote from the 70s, the market is efficient with respect an information set has, if it is possible to make economic profits by trading on the basis of information set has. So we've seen today a couple of equity curves with regard to applying prediction methods, right? This has all been kind of like the statistical point of view, where you might have been looking for, or people presenting this have been focusing on statistical inefficiencies. But once you figure in what we heard about, like slippage and trading costs, etc., right? This might turn everything on its head, and therefore here it focuses on economic profits, right? It's not enough to find something statistically inefficient. You need to be able to profit, to benefit of that, right? And now the newer version of the efficient market hypothesis by Tutor and Granger, also 20 years back. It's newer, it's not the newest, but I think this is here, I guess, for a time to stay. Market is efficient. You see exactly here, given the wording, right, that the formulation is related to the original one from 1978 by Jensen, right, with regard to the information set S of T. Right, so here time is introduced as an important variable, search technologies T of T, and forecasting models M of T. If it is impossible, you see here now it goes further with the formulation, possible to make economic profits by trading on the basis here of signals produced from a forecasting model defined over predicted variables in the information set S of T and selected using search technology T of T. So here technology I would like to highlight, and in this case we could say, well, AI fits basically into this definition in terms of the models and the new technologies that are available, right? Back in the days it was basically ordinarily stress regression, and in most cases, as I've shown before, it was simple linear regression. One, here we would say one predictor variable, right, and one quantity that we try to predict, and a very small information set has usually used a fixed one, right? So times have changed, we have new technologies, and this is getting, how shall I say, for day traders, algo traders, systematic traders, quant people, giving a bit of hope that with the right technologies, the right approaches, and the right models, at least we could expect to find something of what we could call a temporary inefficiency that we can exploit, but we shouldn't expect this to last for too long. That's why there is this arms race to discover alpha, and alpha is fleeting the more people show up, right? So fineness of the assets, therefore the T. So ML-based asset pricing. So now applied to the major problem in finance, right? The asset pricing part, empirical asset pricing via machine learning. So pretty interesting paper again by the team of authors that I've referenced before, right? Kelly and Chu, I would say, and there is a third one here. And yeah, I don't want to read this aloud completely, but here it's, I would say, from a research-oriented point of view, a good case in terms of like using more predictive variables, maybe with highly non-linear relationships, right, in order to now improve upon, yeah, statistical method, traditional statistical methods as well, like empirical asset pricing, by the use of machine learning and methods that are able to deal with, yeah, generally more predictor variables, right, and also with non-linear relationships in this context, right. Again, you will find the link behind the screenshot here so that you can go through this paper if this is of interest to you as well. So I would say a pretty good application to one of the core problems, right? Estimating prices, or in this case, as usual, they focus on returns for stocks. From a practical point of view, I was looking for a source which gives an overview, because I'm not going to dive any deeper into this part. How do companies actually use AI in practice, right? This is the research side of things. AI as a technology used to replace, let's say, ordinary stress regression. And here is what do companies do differently when they are active in finance. And that's a pretty nice overview of 33 companies that use AI in finance. It's from retail finance to whatever, right? So fraud detection, a couple of topics that we have heard about these days, NLP usage, etc. So again, given your interest, you might have a look at that page with the examples and additional links found on that page as well. So of course, people in finance, not only in tech, social media, or whatever, try to leverage what AI, machine learning has to offer. So what does it all tell, basically? If finance in the past was too simple, given a couple of reasons, I only highlighted two. The one is physics envy, is like the striving for the most simple model that is capable of explaining something. The other one is that still many of the methods that you find even in just recently published finance books, right, still show things like the capital asset pricing model, like the mean variance portfolio, etc., pp, right, where people, when they invented these methods and models, simply didn't have the capabilities, the means, the technologies in order to do something more complex, right? It's like when Black Scholes came out with their option pricing formula. It didn't take too long until Texas Instruments came up with a calculator which had the formula, because it was so simple built in, right? But this was more or less, if you like, what was at the forefront of the technology available back in the days, right? There wasn't that much more. They couldn't do Monte Carlo simulation with 1 million of paths and maybe multiple correlated stochastic processes, whatever, what we today do on every notebook, right? They couldn't do it, right? So in the 70s. So what was working was kind of like having a calculator where the traders were sitting there and just providing the 5 or 6 input parameters of the Black Scholes formula, and they were good to go. So now that's enough about the simple models and maybe the driving forces behind it. But now getting back to maybe a path to solutions, right? Adding complexity might be one path. And here I can only recommend reading this article, The Unreasonable Effectiveness of Data, right? And here I highlighted this in yellow, which I really want to read. So meanwhile, sciences that involve you, or maybe I go one up there indeed, because this references like the two formulas that I mentioned before. And it's again referring here to the physics envy, right? And ask the question why so much of physics can be neatly explained with simple mathematical formulas. That's really remarkable, I'd say. Meanwhile, sciences that involve human beings rather than elementary particles have proven more resistant to elegant mathematics. Economists suffer from physics envy, here we get back to the expression, over their inability to neatly, and I've added here in brackets, and successfully model human behavior. After all, finance is, and there have been questions in this regard about animal spirits, etc. It's about human behavior. What do humans do in the markets or on an individual level? I've had like expected utility maximization, traders, preferences, whatever jumps to mind in this context. And when we now have a look at the success and the capabilities of large language models, and we've heard there 175 billion parameters, right? So here the only way, obviously, was to increase the complexity, right? Because natural language simply is pretty complex, right? Everybody who's learning another language knows that, right? Even, you know, when I would ask my son if German is simple, he's, oh, I don't know. Even learning your own language sometimes is involved, right? In terms of spelling, grammar, syntax, style, whatever, right? So here, perhaps when it comes to natural language processing and related fields, so let's put finance here as well, we are doomed to complex theory that will never have the elegance of physics equations or what we are used to in finance. Right? But if that's so, we should stop acting as if our goal is to author extremely elegant theories and instead embrace complexity and make use of the best ally we have, the unreasonable effectiveness of data. And yeah, we can say, we can be grateful that we have much more data available. I mentioned this before, back in the 60s, 70s, 80s, 90s, whatever, people haven't had access to much data. Right? I tell this story every time I needed to walk around with a disk, with a floppy disk, right, and get small tiny data set from a seminar thesis that I needed to pay 20 Deutschmarks for, I don't know, 500 data points, I don't know, 2 years worth of data. These days, everybody can sit in front of their machines, accessing APIs. There are many, let's say, free or at least low-cost APIs these days available that are affordable for any student, I would say, or researcher in terms of like PhD student, right? Data availability shouldn't be that much of an issue anymore, so we really can make the move or the shift to data-driven finance instead of like looking still for pretty elegant, pretty short, pretty concise theories, formulas, or whatever we are looking for, right? So AI as a technology, I think, yeah, it's the following case. We have two major aspects. We have, of course, the ever-increasing volume, variety, and velocity. The three V's, as they are called, the financial data. So we can abbreviate this by big data, right? And we have nonlinear, high-dimensional, and changing relationships in finance. Physicists have indeed the good situation, at least to a very large extent, that nature and the laws of nature are constant over time, at least over a lifetime of a physicist, right? But in finance, not only talking about regimes, but things that are evolving, right? There's so many things that change when we speak in terms of stock trading 10 years ago, 20 years ago, 30 years ago. So many things have changed. Why would we assume that there are relationships that do not change, that are persistent over time? That's not the case, and every practitioner will agree to that, right? They are not even start to assume or assume to some extent that something is constant over time, but most of the theories in finance simply suggest that, right? And they suggest that there might be linear, low-dimensional relationships, or they, although they might, or they are in reality high-dimensional and nonlinear. So that's, I think, the case, and the two major driving forces why AI and machine learning can be considered as promising technology engine for a new finance, right? Data-driven and AI-first finance. So now I come to the second part. What can AI do for us financial practitioners? And that's the one where my heart is actually smiling, yeah, getting excited. From my point of view, ChatGPT and the other LLMs that are around are the killer application for finance, right? So that for me, when I started doing it, was one of the first users. I also tried a little bit of BART, which was long not available in Europe, so I needed to VPN to BART, and I did some comparisons, and BART was pretty bad in the beginning when it came to quant finance, and ChatGPT was already pretty good. So I'm pretty much a fan of ChatGPT and stuck from the beginning to it, and so far I'm still happy with it. Therefore, I write here and other LLMs, but I cannot really talk to any generality or got to any specifics of other alternatives, like the many new ones that are coming out more or less on a weekly basis, like Llama 3 and all the others that are now around, right? So ChatGPT and other LLMs. So LLMs have changed forever the way we can learn, do, implement, and teach finance. AI as a tutor, I find this still amazing, right? Learning finance more efficiently. For students these days, the times have changed that much. So it's, for me, unbelievable. I'm old enough to really appreciate what is happening. AI is a co-pilot. So that's something like, for me, it was, well, or for others, obviously as well, if you do finance, do financial stuff, will help you that much in doing what you do more efficiently, right? And then AI as the engineer, right? Helping you to implement finance, financial models, methods, whatever it is, more efficiently. And now I'm not talking about implementing finance in terms of using AI to do finance, but no matter what you want to do, right? Even if you want to apply AI as technology, as the engine, you can use AI for help in doing so. Or AI as an assistant. This is, I have examples. When I saw this for the first time, I couldn't believe it. So what you can do these days in terms of the multimodal capabilities that the models are providing you with. This is what I want to focus on now, one after the other. I go a bit more deeper, but not too deep, I think. So AI as a tutor. I mean, these are expressions that I read, and maybe others might prefer other expressions in this context. So I've recently given a talk about doing math with ChatGPT, and of course, finance, quant finance in particular, is applied math, right? And here you have a 24/7 tutor at your fingertips. You can learn basically fully individualized, right? It's not like you have office hours, 1 hour per week, where you can see your tutor and your professor and ask a couple of questions. Now, here's of course a simple thing, right? Explain the concept of differentiation of a function in a concise way, but it's comprehensive as necessary. And of course, this is just part of the output that ChatGPT is generating. And first thing you might know here, LaTeX, rendering, formulas, right? Not a big deal. Who is using LaTeX? I think we just had one slide deck based on LaTeX. Who is using LaTeX? Writing it? No, more. Why not? We are here in finance context, right? So I cannot
You guys are
believe it.
using.
I cannot believe it. How do you write your papers and thesis? Okay, so for the word, whatever pages. Oh my goodness. Trust me, this is a skill that you need to learn, no matter whether there is ChatGPT around or not. This surprises me. I don't know how many thousand pages I've written in my life. So that's the first thing. You can ask it basically every question. You can dig deeper. You can say, explain this in a different way, provide a different angle, provide examples, numerical examples, whatever. You can dig as deep as you like. And with your professor, this will never work. I know here on the good ones and friendly ones. It take time, but probably not 24/7, right? Then understanding finance, right? Beyond math, of course, there are financial ideas and concepts. And now I get back to the capital asset pricing, right? If you say, well, he's talking about capital asset pricing, well, what is this after all, right? Here, what I'm writing here is kind of getting a quick overview and summary of financial models, right? A capital asset pricing model written out here a little bit differently than I had it on my slide before. But I'm also asking here empirically about empirical stuff, right? And to summarize, its empirical support was the second part of the question in the upper left-hand corner, right? Empirically, Cap M has mixed support. It is praised for its simplicity and its intuitive approach risk, reward, and diversification. However, numerous studies have challenged its. This here, where's the mouse? I need to move this a little bit. Its accuracy in practice. Historical performance, bad, right? Anomalies, well-documented anomalies. Single factor limitation. Here we have like linear relationship, just one factor, low dimensional linear. Behavior critique. So you can dig deeper and I can say, well, which paper is like elaborating on point number 1, etc. pp. So it's not only math, which is important, but it's also finance, right? Then summarizing papers, still a killer application for me that I can upload any kind of PDF and I can say, give me a concise summary. And here I did it with a paper that I was mentioning before, because it's a relatively thick paper. And I was asking here, I think, about the my prompt is not shown here. Key points, I think it was asking for exactly this, the 7 key takeaways or key points here. Physics envy, misguided precision, taxonomy of uncertainty, harmonic oscillator analogy, quantum financial crisis, uncertainty checklist, future of financial modeling, and then you get your 1 sentence. And you see here, it says, here's an even more concise summary. So I was asking for something concise, but it was still like blah, 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 blah. And I said, give it in a more concise way, and it gives me the same thing in a more concise way. So back in the days, I was like having something on a reference list, I was working to the library, I was looking where I can find the journal with the exact volume number, etc., right? And I needed to climb up the stairs and like I don't know, 3 meters high. I was able to pick it up. I went out, I did a copy, I got back home by bus, right? And I started reading what was in the paper, and then I had a bunch of these. I tried to summarize them. Right? But here it simply said, well, give me a summary. And for like standard papers, many books out there, if there hasn't been kind of like claims by the copyright holders, you can even get, give me the summary, I don't know, book that jumps to mind, Atomic Habits, for example, and you get a summary of their book. And so even if you have not read or available a PDF copy or whatnot. So summarizing papers, maybe even multiple papers, this works, I would say, like a charm. And again, you can dig deeper and deeper and deeper, right? Generating quizzes, I think one of the last time I was giving a talk, I was already saying that this is nothing that I ever like to do. And ChatGPT helps you with that as well. So here, yes and no questions, multiple choice questions, whatever, test project, exercises, whatever you're asking for a certain topic, it will help you out and generate 10, 20, 100, 500 different questions if you fancy that one, right? So that was tutoring, and there are for sure a couple of more aspects that could be highlighted in that context. So as a Copilot, right? So here, solving problems. This is again from my math talk that I've given recently. That's from Bachelor of Science and Mathematics program. Here, it's a exercise, a problem about a series, and the question is for which numbers x of the real line the series is convergent, right? So this is in German, obviously, you might notice. Right, and I first asked to translate it and then to provide a detailed solution. And it translates it, including the LaTeX stuff, right, and then it starts applying the appropriate stuff here, right? We can use the ratio test for convergence of series according to the ratio test, blah, blah, blah. Later on, I go on what is about the left limit of the interval, the right limit of the interval, etc. And it does it like a charm, right? So math capabilities are there, wonderful, not only about explaining concepts, but also in terms of solving certain problems, right? Then making educated guesses. This is also pretty interesting. I've uploaded this as a PNG, and I say, well, analyze the attached graph carefully and derive the generating function, derive first and second derivatives, and plot all three in a new figure. And it already starts with, oh, this looks like a cubic function. A cubic function has a general equation like this, blah, 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 and then it moves on. And at the end, it provides Python code, and the Python code generates a cubic function with the first derivative, the second derivative, right? This is like an educated guess. So it has quasi a look at the chart and recognizes this as a cubic function. Of course, this does not work for everything, but it has like this, kind of like filter where it says, well, I recognize this. Then a very similar problem, but this time I'm asking something else, and it again gets it correct where I dotted the same function, but this time as dots, and I'm asking it here to, you see it on the lower left-hand side, determine the coordinates of the dots in the figure based on educated guesses. And then I move on with additional questions, right? And you see here the plot as well. So it figures out the coordinates of the dots, and then it comes out with a functional description, and again, the first, second derivative, or here it's just maybe the first derivative, and it plots this. So it can analyze also stuff like this, right? I came to the idea by discussion with a mathematics professor, actually, who I had when I was studying for my business administration degree, and he said he later on changed, so he's retired now, he later on changed to these visual tasks, right? Because he was saying with the equations and here and there, many people could learn certain things. He said, well, this is where you really see if people have an intuitive understanding of how math works and what the first derivative is, and when you have like certain situations, etc. This is how I came up. And we said we had a web call and said, let's give it a try. It's so easy to do, and ChatGPT actually can. So I, as an engineer, of course, I was amazed by that as well. So here, typical example, uploading the data set that I use for my book, Reinforcement Learning for Finance. And I say, provide a concise summary of the attached file. Then it uses pandas to analyze it, blah, blah, blah. Here you see some output of the code. And then it explains what's in the date. Then it explains the single rigs actually here this was from Workspace, LSCG, right, and explains what the different symbols stand for and what the data set contains. And then you could go on, right, plot it in a normalized fashion, derive, I don't know, log returns, do X, Y, that, even apply some machine learning stuff to do whatever, right? So fantastic. Data science, automated, or here in that case, financial data science. Or implementing models. So provide a concise implementation of a flexible model for European option value. And then you get the implementation with explanations of what it can do, what the parameters means, what the output is of this. So yeah, when I started out, this was basically my idea, and I stuck to it for quite a little while, just to take one model after the other and get it implemented in Python. That's the way I basically learned Python, not in a systematic way, but just by back in the days by implementing financial models because I was interested in it. I had a relationship to it, and I thought this a fruitful endeavor. And in particular, I can tell you, I've spent I don't know how many hours in my life, and this culminated later in the publication of derivatives analytics with Python with the Longstop-Schwartz algorithm, which came out in 2001. For the Monte Carlo-based valuation of American options. And I've spent hours and hours and hours on then really understanding it and getting this implemented up and running, getting it to provide accurate formulas. Then later on to speed it up, I even gave a talk in Paris about the fast valuation of American options with that approach. So I spent a ton of hours in here. You simply say, give me a concise implementation. And it does. And I checked the code here that was given out for executability and correctness. And this works like a charm these days. Right? I don't know if this is always the best to have this this struggle to learn something, to get something implemented on your own. Of course, it's a fruitful endeavor, but I don't know, in practice these days, when you have like deadlines and like exams coming up and whatever, right? Spending hundreds of hours, dozens of hours on something that the machine can do in a minute, I don't know. So now as an assistant, and this for me, now I have examples for me, they are like the most exciting ones, to be honest. Some of you might have seen this on the web, probably not in practice. When I got started, there's still these papers around. Here I'm showing basically the original thesis by William Sharp. Again, we are back here to the capital asset pricing model. Sharp Lindner, right? And back in the days, these papers, thesis, documents have been written by assistants with typewriters, right? With typewriters, when you have a look at the formulas down there, right, they move like the paper up and down in order to get like these settings, right? Today we are saying, yeah, that's a subscript, superscript, whatever, but this hasn't been around there, right? People were writing letters back in the days on typewriters and not technical papers, right? And every once in a while, you also saw, of course, that somebody was like doing something with a pen in there, right? Which was not possible to do with a typewriter. And you can imagine if somebody was typing like 50 pages and they say, oh no, chapter 3, it's in change, right? But the numbering of the pages, we need to stay consistent, right? It was a big deal, right? And then someday LaTeX came around, which is still the standard today. It's one of the, I would say, most successful technologies that have survived, and the language itself for publishing purposes that long. It's amazing, right? So here, what I was saying, this multimodal as a starting point, I was writing this very simple integral. That's my handwriting here, and I uploaded this. This was photographed on my MacBook keyboard, right? And I said, read the integral, transform it to LaTeX, and solve the integral numerically by using the antiderivative, explain every step in detail, and it simply does it, right? It recognizes the integral, it provides here the LaTeX code, which I can copy. Right, it renders it first, you see it up there as well, or it renders it, and then it explains what the solution steps are. It provides the antiderivative, it basically explains that e to the power of x is also the antiderivative, as we know. It's also the derivative in the other direction, right? And it does it, right? This alone for me is already, it recognizes it, and it knows like these different things, like the math side, the visual capabilities, the LaTeX programming, markup language, if you like. It's fantastic. And then this was just like, how should I say, the toy example, the sandbox example. But this is a real use case because the math professor that I was mentioning before, he has published our book. I was like reading the first edition and ended with the fifth one or what in German. And I always thought, because he has like a ton of exercises and everything included, right? I say, well, we look for a translator who might translate this into English because I would like to use it in my program, the CPF, etc. Right? And I wasn't successful in finding somebody who was able, capable, and it wasn't even a price question, right? It was just like, not finding somebody. And here I uploaded a screenshot of a page or part of a page of his book, right? And I was asking from the text screenshot, generate a self-contained complete LaTeX script in English that generates output whose layout is like the original. And it reads it, it does OCR on it, right? Here you see the LaTeX, right? That's the LaTeX part, and that's the English rendering. It even goes with a proper numbering here, right? So everything is properly numbered. It looks slightly different, but it's exactly the same. And it does like all these steps, recognizing what is in the screenshot, generating the LaTeX code to get all these formulas and everything correctly rendered. And I just needed to get the code and run it on LaTeX, and it did render out of the box. So there was no issues with like, I don't know, tweaking or doing something. That for me is kind of, I still can't believe it that this works like a charm these days. It's simply wonderful. And again, if you would have done a bit of LaTeX in the past, you would know what I'm talking about. Because this is not like writing here. When you have a closer look at this, it's not too large here, right? Have a closer look at this, particularly these formulae with all like these matrices and vectors and stuff. That's kind of involved in typing it out. Even if you know how to do it, you always get something wrong, right? Where you need to go back and forth, back and forth. So let me come to the conclusions of my talk. And I would say AI is the major driving factor today in finance. And it's one of the reasons why we are here together, and I've seen already quite a few interesting and even exciting applications, and we will see even more so in the afternoon. But I would summarize this as follows from my personal point of view. Right? AI as technology is established, but it still has to prove that it can significantly improve finance as compared to traditional methods, or we can even narrow it down, empirical methods. So a lot of hype, and here I would see it's a bit of overhyped. It used to be in the past, right, where there have been so great successes in other domains, but the technology side so far, I would say it will take a while until this aspect will be the dominant in future financial textbooks, I think. So this will still take a while. On the other hand, and this was the second part of my talk, obviously, LLMs as Tutor, Copilot, engineer, and assistant have opened complete new, and from my point of view, it is a wonderful world for finance students, researchers, and practitioners alike, right? So experiencing finance, given what the AI can do for us, right, is, I think, simply the most, from my point of view, the most amazing aspect these days, right? And here, this is from when I was flying over from Germany, 22nd of April, last Monday, Financial Times. Of course, I spotted this article, commodity traders rush to harness AI. And what I was trying to point out here, right, as my conclusion, as the summary, I think this quote brings it to the point, right here. From the point of view of commodity traders, it's the CEO of one of the companies here, Hardy. I think we are all trying to get to the moon first, right? There's billions and billions at play, but I would say that it's helping with business efficiency today more than cracking the code of what the market is going to do this afternoon. So that's for me the summary as well. All these predictive models and efforts, etc., might be nice, but still not at a point, I would say, where they would replace the traditional methods. But in terms of the efficiency, my point was in terms of the efficiency of learning finance, doing finance, programming finance, and publishing, teaching finance, right? This this is simply a given. The net benefits are huge. And to close out, this was last week on the 18th of April. It's one of the few newsletters that I subscribe to. It's from Matt Levine, Bloomberg, right? It's about AI returns, it's about OpenAI. And I just want to highlight down here this quote, right? Sam Altman, once we build a generally intelligent system, right? Or AGI maybe, basically we will ask it to figure out a way to generate an investment return for you. So maybe in the future, the generally intelligent financial intelligence will tell us what best to do with what is available. Thank you.